Hey everyone! Welcome back to Invest with Alex, where we break down investing and finance in a simple, easy-to-understand way. If you're new here, make sure to hit that subscribe button and turn on notifications so you never miss an episode. Today, we're diving into one of the most commonly asked questions in investing. What's the difference between mutual funds, ETFs, and index funds? These investment vehicles are all ways to diversify your portfolio, but they each work a little differently. By the end of this episode, you'll know exactly which one fits your investing style best. Let's get started. Alright, let's break these down in simple terms. Think of them as different ways to own a basket of investments rather than picking individual stocks yourself. Mutual funds: imagine a group of investors pooling their money together. A professional fund manager decides where to invest it, whether in stocks, bonds, or other assets. You don't have to manage it yourself. Exchange-traded funds, ETFs, similar to mutual funds but trade on the stock exchange like individual stocks. This means you can buy and sell them anytime during market hours. Index funds, a type of mutual fund or ETF that follows a market index, like the S&P 500. These funds are passively managed and tend to have lower fees. So, mutual funds and ETFs are structures and index funds are a strategy. Now, let's break down their key differences. Let's talk about mutual funds first. Here's why some investors like them. Professionally managed, experts decide what to buy and sell, so you don't have to worry about stock picking. Diversification: your money is spread across multiple assets, reducing risk. Automatic investing: you can set up recurring contributions, making investing hands-off. But there are downsides too. High fees: many mutual funds have high expense ratios, cutting into your returns. Limited trading flexibility: you can only buy or sell at the end of the trading day. Performance issues: many actively managed mutual funds fail to beat the market over time. So, mutual funds are best for long-term investors who prefer professional management and don't mind higher fees. Now, let's talk about ETFs, which have become super popular. Why investors love ETFs? Traded like stocks, you can buy and sell them throughout the day. Lower fees: most ETFs have lower expense ratios than mutual funds. Tax efficiency: ETFs are structured to minimize capital gains taxes. But ETFs aren't perfect. Potential trading costs: some brokers charge commissions on ETF trades. Price fluctuation: ETF prices move throughout the day, which can be overwhelming for beginners. No automatic investing: unlike mutual funds, most ETFs don't allow recurring contributions. So, ETFs are great for investors who want flexibility, lower costs, and easy diversification. Now, let's talk about index funds, one of the easiest ways to invest. Why index funds are a great choice. Low fees: since they're passively managed, they cost much less. Market matching performance: instead of trying to beat the market, they track it. Great for long-term investors: historically, broad market index funds have strong returns over decades. What to consider before investing in index funds? Limited selection: you're only tracking an index, so no active decision-making. No huge short-term gains: you won't see massive growth like you might with individual stocks. Index funds are best for passive investors who want steady growth with minimal effort. So, which one should you choose? Here's my take. If you want professional management, go with mutual funds. If you want flexibility and low fees, ETFs are the way to go. If you want low costs and long-term growth, index funds are your best bet. Many smart investors combine these options for a well-rounded portfolio. Alright, let's wrap this up. Key takeaways. Mutual funds are actively managed but come with higher fees. ETFs trade like stocks and offer flexibility with low fees. Index funds are the simplest way to invest with low costs and long-term growth. The best investment depends on your risk tolerance, investment goals, and trading style. Research which type of fund suits your needs. Open an account with a broker that offers mutual funds, ETFs, or index funds. Start investing with a long-term mindset. If you found this episode helpful, hit that like button, subscribe, and leave a comment. Which type of investment fund do you prefer? In our next episode, we'll be covering how to build a diversified investment portfolio, so stay tuned. See you next time.